Hello everyone. Today I am going to be presenting on the topic of mergers and amalgamations of private limited companies, and we'll be looking at the reportings and the compliances. So first we'll look at what is a merger, what is an amalgamation, and also another type which is an acquisition. So after we get to know the basics, we'll look at what are the laws which will be governing these mergers and amalgamations. Then we'll be looking at how are the different types of mergers or amalgamations done. Then we'll be looking at how it can be done step by step process wise. Then we'll be looking at how is the accounting done and disclosures done from an accounting point of view. So first of all, when we say a merger, it is nothing but two companies combining into one, where one of the company continues to exist and one ceases to exist. Then an amalgamation is a type of restructuring where two companies combine to form a completely new entity, whereas wherein the two existing companies no more continue to exist and a completely new entity comes into existence. So when we look at an acquisition, acquisition is nothing but a merger where one of the companies is having a controlling interest in them. So it is like let's say there is a company A. So if company A acquires company B, the company B will no longer exist, whereas only company B will continue to exist. Similarly, when we look at an amalgamation, company A and B, they used to exist, but after an amalgamation, a new company named company AB that starts to exist, and company A as well as company B both cease to exist. And when we look at a merger, there is a company A as well as company B which used to exist, and after a merger, only company A exists as a company B is merged into company A. So now we'll be having a doubt, like how is a merger different from an acquisition? When we look at an acquisition, it speaks of controlling interest, whereas a merger could be a joint interest, like where 51-49 or maybe 50-50 also. But in an acquisition, majority of the interest is always with one of the companies. So now we'll be looking at the governing laws. As it's registered as a private limited company, the Companies Act comes into picture. So section 230, 231 as well as 232 speaks about the process of a merger, like what are the steps which needs to be followed. Section 233 speaks of the fast track merger, which is a type of merger applicable to small companies holding subsidiary pairs, etc. Here, most of the tedious processes like the NCLT approval and other procedures are reduced, and only the approval of the regional director is required. Then comes section 234, which speaks about cross-border mergers. In cross-border mergers, one of the company will be a domestic company, which is in India, a domestic private limited company, and then the other company will be a company outside India. So here there is two or more entities involved who are there in existence in two different countries. Then there is the Income Tax Act 1961. So in this Income Tax Act, they mainly speak about the carry forward provisions as well as the capital gains which arises during these mergers and amalgamations. Then the Competition Act of 2002. The Competition Act of 2002 basically regulates the competition with a specific industry. So if in case there are two giant players in an industry merging into one, this may lead to a monopoly. So the Competition Act 2002 regulates this mergers and amalgamations if in case they hamper the competition in the industry. Then comes the Foreign Exchange Management Act 1999, which is also known as FEMA. So here, if in case it's a cross-border merger, then this applies. Then now we look at the different types of mergers and amalgamations which are possible. First is through the regular mode. So here we'll have a formal approval from the NCLT which is required, and this is the normal step-by-step procedure which we'll be looking at in the coming slides. Next is the fast-track merger. Over here, it is available only to small companies holding subsidiary pairs and wholly owned subsidiaries, as I had said before. So here they don't require the NCLT's approval. Here the regional director's approval is more than enough, which will significantly speed the process. Then comes the cross-border mergers. Section 234 which I spoke of is this cross-border mergers. So here the companies which are in existence in two different countries, where one of the company is existing in India, so they require additional approvals, especially from bodies like RBI, as foreign exchanges are coming into picture. So now let's look at how a merger or an amalgamation takes place. So initially, the company has to ensure that their charter documents allow for a merger and amalgamation to take place. So if in case the charter documents such as the articles or the memorandum do not allow such mergers or amalgamations to take place, they can pass a resolution and ensure that it is in line with the charter documents. So once that is settled, next comes the drafting of the scheme or arrangement. So here, once the scheme of arrangement is drafted, which is nothing but who will have how much control. Let's say company A and company B are merging. So who will have the majority control, or who will have the control? If in case someone has the control, how will the shareholding split? How will be the this thing gain split from these mergers? Like how will a merger actually be formed, just from a broad perspective? So once that is drafted, then the board meeting will take place, wherein this draft will be analyzed, and then a resolution will be passed accepting the draft. So after that, the first petition to the NCLT will be filed. So after the board meeting, the resolution has to be passed by them, and then that should be filed to the NCLT saying that from the company's point of view, we are ready to get into a process of merger and we are initiating the process. So once that is done, the NCLT will say to send notices to the regulatory bodies and stakeholders. Here, regulatory bodies include the Competition Commission of India. Let's say the NCLT is fine with the merger taking place, but then the Competition Committee says that as these two companies are extremely valuable and the merger of these two would lead to a monopoly-like situation, they may raise the red flags with this situation. So, if in case such situations arise and the red flags are raised, then they need to sort the matter out and ensure that these red flags are no more existing and a green flag is given by these authorities. So, and also they require the approval of the members. So, as it's a private limited company, we know that 200 members are the maximum which can be there. So now we'll look at what are the provisions, like how much percentage of members needs to give their approval, how much percentage of creditors needs to give their approval. So here, it depends on like whether we are going through a regular merger or a fast track merger. If in case it's a regular merger, then we need dual approval, which is the majority in number as well as 75% in value, which means that more than 50% of the people in number, that is, let's say there are 100 people in the company, and over here it is at the meeting. So let's say there are 200 people in the company, but then only 100 at in the meeting. So out of the 100, majority number, which is 51, not 50, 51, because that is the majority. So at least 51 people should agree to it, that the process of the merger can take forward. And 75% in value. Let's say 51 people agree, but those 51 people have only 10% of the total value of shareholders. Then it is not deemed to be as accepted, as it is a dual approval which is required. And similarly to the creditors as well, majority in number and 75% in value is required. So these are formal meetings where voting process takes place, which is why this is a formal procedure and it is a time-consuming procedure. So if in case it is a fast-track merger where small companies are applicable to do this, 90% in number, their approval is required. And here it is not through a meeting, it is through a written consent. So here there need not be a meeting which needs to be taken place. They just need a written consent saying that they are fine with it. So over here, as it is written consent, the approval limit is more. Like it is not 75% or majority, it is 90%. So 90% of the members needs to accept it, and 90% of the creditors in value. Or here the number doesn't matter, it is a value. Let's say 1 crore worth of creditors are there as per the company's books. At least 90 lakhs worth of creditors. Let's say if it is single entity also, if they are having 95 lakhs worth of value, then if their approval is taken, that's more than enough. So after that, we take the approval, and once the approval is done, this needs to be filed to the NCLT saying that, see, we have complied with all the procedures, and these are the results, like saying that out of 75%, out of the people, number of people who have voted, at least 75%, which is let's say 80% or 90% is approved in the meeting. So they need to give the whole details in the form of meeting results. So after that is given to the NCLT, they will have a hearing. So once this hearing is done, they will look into whether all the conditions are met, whether any red flags are still remaining which are raised by any one of the authorities. So after everything is done, they will give their final approval. So after this approval is received, this scheme needs to be filed with the ROC, and they need to get the clearance of the NCLT or the regional director depending on the type of merger which has taken place. And then finally they have a few post-merger filings as well, which we'll be discussing in the next slide. So here we will be looking at the different forms which needs to be filled throughout this procedure. So initially to start the process, NCLT 1 needs to be filled. Then the notice of the admission should be done through form NCLT 2. Then an affidavit in support of the application should be given in NCLT 6. And when there is existence of creditors or the members, their CA 1 is required. So after that is done, the GNL 1 is optional, where you have to submit your documents to the ROC as and when the NCLT submission is done. After that, the communications to the members as well as the creditors is gone through the form CA2. Then a notice to the regulators, which is the Competition Committee of India, the IT department, or maybe SEBI. It is done through form CAA3. And then all these meetings, the dates, the timings, the venues, everything should be published through newspaper, one in the vernacular language and one in English. Then the meeting should be conducted in a formal manner with the chairperson conducting the meetings. Then form CA4 needs to be filed, wherein you will put your meeting results saying to the NCLT that yes, we have complied with the provisions, look into it and give us your approval. Then once this final petition is filed, the NCLT will pass an order through form CA6, and then once that is done, we need to file the NCLT order to the ROC with form INC 28. So after that is done, then the post-merger compliance is the only thing which is left. So if in case there is an increase in the authorized share capital because of this merger, then a form Asset 7 needs to be filed. Then a form PAS 3 needs to be filed in case of return of allotment of shares to the transferee company holders. And a form CA8 is an annual statement of compliance post the merger. Then there are some optional filings such as MGT 14, which is board resolution filing for the scheme approval. Then AOC 4, which is the updated financials after the merger. Then DIR 12, if in case there is any changes due to this merger in the directors. So now as the process of the merger has taken place, now we need to know how are we going to show this in our books. So here we will be looking at from the accounting standard point of view and the Ind AS point of view. So from the accounting standard point of view, there are two methods. There is the pooling of interest method, wherein all the assets, liabilities and the reserves are taken at book value and there is no goodwill which arises as it is taken in the book value. And there is also a purchase method. This is mainly when acquisitions take place. So here there is an asset or liability which is taken at the fair value, and as it is taken at the fair value, there is a difference between the fair value and the book value. So the difference will be either taken as goodwill or capital reserve depending on whether it is a positive difference or a negative difference. So similarly in Ind AS 103, which speaks about the mergers and amalgamations, under the acquisition method, all the assets and liabilities are taken at the fair value and the goodwill is recognized. Then there is a common control transactions which is also known as pooling of interest. So here it's like a merger which has taken place and it is taken place, taken in the books at the book value. So now this was a brief idea of how a merger or amalgamation takes place in a private limited company, like what are the reporting procedures which needs to be done, what are the compliances which needs to be taken. So that's all from my part on this topic. Thank you.